Okay, good. Hello, everybody. Very, very close to good afternoon. So I think we may have 30 seconds left, but I'm just going to go ahead and tee this up. Welcome to our Exit Advisors Town Hall. This is something that we do on a weekly basis where we have very compelling discussions and hopefully provide rich information that can help you with your business operations, succession planning, and a lot of other topics. We are also utilizing our entrepreneurial network to where we can give you the best possible advice from leaders who have actually done it. So teeing up, who is Exit Advisors? Exit Advisors is a Houston, Texas-based company that specializes in sell-side consulting, mergers and acquisitions. Transactions ranging typically from $5 to $50 million. Our goal is really to maximize value for our customers, going through the valuation process, pitch deck, finding a good strategic deal, and helping with the ultimate exit. We very much take an education approach to where we would like to teach our client best possible strategies and going through the exit process. We're building a very strong data room, putting together very rich financial information, and obviously getting the best possible price. Today, we have Jason Knight who's going to present. It's going to be a great topic dealing with cash flow. And I wanted to introduce Jason because he's my EOS implementer. That's the Entrepreneur's Operating System. And this is an offshoot from the book called Traction, written by Gino Wickman. Jason has done an incredible job with our organization, really defining our core values, who our customers should be, putting the right people in the right seats. Each organization will probably have a strong visionary, but there's got to be an integrator with that as well for a good balancing act. So he's helped us establish strong accountability, reporting, establishing rocks, which are 90-day goals that we are committed to complete, have a very, very strong weekly to-do list. And we have what we call level 10 meetings to where we really get into the issues of the business and solve those issues before we leave the meeting. So Jason, in essence, indirectly helps manage and run our business. And I'd like him to be able to introduce his wonderful experiences that he's had and just go right into the topic, dealing with your cash flow, your lifeblood. Jason?
Thank you, Gary. That's great. Appreciate that intro and those kind words. Wanted to give just a quick background. So as Gary mentioned, I'm an EOS professional implementer. But before that, I've been an entrepreneur for about 30 years now, hate to admit it, and growing and having opportunity to sell a number of businesses along the way. My last large company that I've built and sold, we started in 2005 as an IT services and product reseller, and grew that company from zero, basically bootstrapped it from zero to about 50 million in revenue in about 9 years. So 2014, we sold that organization into a roll-up, and because we were the largest of that roll-up, we were tasked with running the roll-up and continuing to grow that. So had an opportunity to build that company up to almost 100 million or so in revenue and about 250 employees, and a lot of experience and good and bad along the way, some lessons learned. But the way we grew was some organic, but a lot of acquisitions. Our strategy was to go in and acquire smaller firms that were great at doing what they did. They were great technicians and excellent in their field, but not necessarily great on the business side. And so we would acquire them. We would take over the business element and allow them to continue to operate the business, and run the technical side of it. So the challenge that we ran into was that, as you can imagine, a bunch of entrepreneurs all rolled together. It's like herding cats. Getting consistency in the way we did things was really important. So we went on a journey to find the right solution and found EOS as the right solution for bringing consistency in our vision and our execution and discipline throughout the organization. So we used an implementer out of Dallas, a guy named Mark Winters, who is the author of Rocket Fuel, and great guy, very talented EOS implementer. And then once I got done and retired out of that last business, we continued on doing EOS implementation for other companies. It's just so much fun to dig in and see how things can be structured and improved, and just see the growth and the freedom that comes from that, from business owners that have been really bogged down into their business, but getting them to think about strategically how they can grow it and distribute some of the burden to a leadership team that gets elevated and really executes well. So with all that said, that's what I do. And part of what we do is an exercise called the 8 cash flow drivers. And so normally this is done as a workshop. And I will say that this is going to be tough as a lecture a little bit, but just because this isn't directly interactive doesn't mean that you can't be participating actively on your side. So I encourage you to get out a piece of paper, a pen, open up a Word document, whatever you need to do to participate actively in this. So this is cash flow, managing the lifeblood of your business, but it should be called the $50,000 hour. And I say that because it's very common for my clients or for businesses that I work with to find substantial money in their business just by going through this exercise. We did this on Friday with a client, and in 3 hours, we found $120,000. I've done this with larger organizations where we found several $100,000 in just a matter of a few hours of going through this. Now, you have to realize this through the discipline of executing on some of the decisions and opportunities that come from this. But hopefully you're going to find that this inspires you to think about your business in a different way than maybe you've thought of it before. So that also means that this is not an academic approach to cash flow. We're not getting into best accounting practices. We're not going to get into the technicalities. Many of you on this call may have an MBA. You may know cash flow inside and out. And that's not necessarily what this is. So some of these principles are going to be very basic, eye-rolling basic, but just because it's simple doesn't mean it's easy. And I want to make sure that you don't get stuck in a mode where you're thinking about something the same way over and over again and maybe haven't had a chance to look at it through a new lens. So the example I'm going to give on that is how at 42, I learned how to retie my shoes. So at 42, I started doing CrossFit, and you wouldn't know it now, but I was doing CrossFit for a number of years. And it was interesting. In CrossFit, you spend a lot of time on the ground staring at other people's feet, kind of up and down a lot. And I noticed that other people with the same shoes that I had didn't have the same problem I had. I had a problem with my shoes coming untied all the time. I always have. And I just assumed that's reality. So you had double knots and all those things. But I looked around and saw that other people didn't have double knots, and they had no problem with their shoes not coming untied. And something as basic as that, I've been doing it all my life. I actually stepped back and went and Googled how to tie your shoes. And I found that there's actually a couple of ways you can do the same knot that looks the same. One is a really weak knot, and the other a really strong knot. And it just has to do with the direction that you go with the loop. It's the same knot. If you just go one direction, it's weak. You go the other direction, it's strong. So if you look down at your shoes right now, if your shoelace is vertical, you're doing it wrong. If it's horizontal, you're probably doing it right. And you probably were just taught that way. So that's just the nature of it. So today, I'm going to ask you to maybe relook at some of the things you're doing that are fundamentally, maybe you've known forever, but maybe we're going to look at it in a new way and give you some thoughts and ideas on how to do it differently. So just for starters, very, very basic income statement. just to get consistency in our terminology, obviously revenue, top line, what are you selling? And by the way, when people think about growing their business, 9 times out of 10, even those who have a strong financial background, they oftentimes think about revenue. Let's go sell more widgets and bring in more cash. So that's revenue. We're going to talk about that. We'll talk about cost of goods sold. Obviously, revenue minus cost of goods sold is your gross profit, minus your OPEX is your net income. But the reality is that net income oftentimes does not equate to actual cash in the bank. And so one of the challenges that if you've been in business very long, especially if you're cash basis, at the end of the year, looking at your net income statement and looks great. You get all this money. Actually, if you're accrual, even worse. But you got all this money on the books that you got to pay taxes on. You may not have the cash in the bank to pay taxes on it. So no surprise there. But we're going to talk a little bit about how to make sure that we have more money in your pocket, not just on the statements. So again, this is about as technical as we're going to get from an accounting standpoint. We've got folks on the call that we can certainly dig deeper if you want to. If you want to get into a discussion on cash flow and management projections and reports, I highly encourage you to get in contact with Gary and his team and look at it on a consistent basis, monthly, quarterly, annually, actually doing cash flow projections and get into the technicalities of how to best report for your business. But today is not about that. It's about thinking creatively on how to find money in your business. By the way, I usually work on a productivity number with my clients that's just gross profit by OPEX to come up with a ratio to figure out how healthy you are so we can measure it on a consistent basis. Again, we're not going to spend too much time there. And again, very fundamentally, what we are talking about is cash in, how to increase the flow through the faucet, cash out, how to decrease the outflow through the drain. If we can shrink the drain, we're going to raise your cash balance. The water level in the tub is going to go up. If we can increase the flow, water level is going to come up. Our goal is to have the tub overflowing. That's when distributions and dividends and all the good stuff happens, right? So that's the simple approach that we're going to take, but there's a lot of money to be had there. So first off, of the 8 drivers, the first one being just sell more units. That's obvious, of course. Everybody knows that. Go sell more, you make more. So assuming that you're profitable, what does it mean to sell more? And one thing that in my businesses, we always looked to our existing client base first. It's easier to sell more to your existing clients than it is to go acquire new clients. And so making sure that you're selling more products or the full breadth of what you sell to your existing clients. It's an obvious statement, but if you really pay attention to the client share, the customer share that you've got, in other words, how much of your clients spend in the category of services you offer, are they spending with you? So make sure you know that, but just simply by asking half the time. The second is selling existing products and services into new clients. Again, another obvious direction that you can take it. The caution you see in the bottom right here is not selling new products to new clients. Not to say that you can't do that, but that's not going to increase your cash flow immediately. Obviously, that's going to be a very expensive venture, and not to say you don't go down that path, but understanding the impact and consequences of that investment. By the way, there's a lot of words on these slides coming up. You will be getting copies of these, so don't worry too much about having to capture too much of these notes. But again, as we're going through this, I want you to be thinking about your specific situation, something you can do to improve your position in this case, a commitment that you're willing to make in that area. Put a time frame on it and then put a name on it. Who owns that? And then to what degree are you wanting to improve that area? So if that means that your average client is only using 20% of your products, and you can increase that to 50% of what you sell for your average client, well, obviously you're going to see growth there. By the way, also when we talk about scorecard here, that's an EOS term, which is just a report that we use on a weekly basis with the leadership team. It's 5 to 15 numbers that we use to measure your company. And so the leadership teams are looking at this, and the numbers need to mean something. You need to understand the correlation of the numbers, understand the story behind them. So when a number moves, why did it move? What does it mean if it moves? what's the impact, so that we're getting better at near-term prediction of revenue and all these details. The second is you can raise prices or avoid discounts. So one of the issues that I see consistently is uniform price increases or discounts across the board. Everything is 10% discounted or 10% increased. And that gets dangerous for a few reasons. I'm all for standardization of pricing and standardization of your sales process, but uniform pricing increases or decreases gets a little dangerous. And part of that is that you're leaving opportunity on the table. So by adjusting pricing in certain areas where you can maximize margin, maybe potentially in an area that's less scrutinized, a widget component that maybe is not normally price shopped versus something that has greater attention on it, that's one way that you can look at your pricing and adjust it on a per component level, which can equate across the board in greater price increases. The second is also understanding that discounts have a huge impact on your cash flow. And so one way to maximize your pricing is just simply by reducing discounts. So some of the tips here, just making sure that you're looking at your clients on a one-on-one basis. If you're willing to lose, go for larger price increases. I'll talk a little bit about willing to lose there. If you're adamant about keeping all your clients, just making sure that you're increasing value for the dollar. So you can increase prices and ensure that you're going to have a better chance of keeping all your clients, but by improving the value that comes along with it. Also understanding if you're out of capacity. So that's something that's obvious again, but we don't always do it. So in the service industry, it's not uncommon to go into an organization that's running at max capacity and they're trying to figure out how they can improve their profitability. Well, one way to do it is simply increasing your prices. If you're already at max capacity, then there's room there for price increases. Same thing if you've got true differentiators. If you offer a value that your competitors don't, then it's worth more money. So when you're competing with them, you're not apples to apples. So making sure that you are able to communicate your core value to your client and the key differentiators is important, that you understand those, but you price accordingly. And of course, reducing discounts equals price increases. So right now is probably not the greatest time to go out and tackle price increases across the board. Although in certain industries, we're definitely seeing where it is. So you have to really understand your industry and understand your client base before you tackle that issue. But don't assume just because the current climate we're in that there's not opportunity for price increases. There certainly can be. So on the scorecard, understanding your percentage of sales at discount, how much of your total sales across the board are you discounting off of MSRP? By the way, in the IT world, it's very common to have a very high list price on products and have a very steep discounts. And unfortunately, we've created a culture where that's expected. It's not uncommon to see a product that's a $100,000 widget that gets sold for $35,000. So 65% discounts. Well, there's a problem with the list pricing at that point, but it also has created an expectation of significant discounts with the client base. And that's a problem that needs to be addressed a little piece at a time. And we've got several clients where we're working on doing that. One more little tip on discounts and price increases. We tend to think in whole numbers, 10%, 20%, 35%. Just nothing wrong with odd numbers, right? So if you want to increase your prices by 8.5%, or if you have to give a discount, don't go to 10%. 7.5 would have been fine. 6.25 would have been fine, right? So think through where you want to be, not just an arbitrary number. And that's a trap that salespeople often fall into. And make sure that you're analyzing that. So that percentage of sales at discount and percentage of discount is a really important number to look at on a scorecard. The other thing I want to talk about is the cost of discounts. So if you've got a sales team, you probably have experienced this. When you talk about price increases, the first thing they say, we're going to lose clients, and they're very quick to go to discounts. But if you have a gross profit number that you're targeting, let's say it's 40%, if you look at the numbers, you can actually afford to increase your prices by 10% and maintain that same gross profit number and lose up to 20% of your business and still maintain that number, versus the other way around. If you discount it by 10%, you've got to find 33% more business to make up for the lost gross profit that you just discounted. So the impact of discounting can be significant. So don't be quick to discount. All right, so the next area is just simply to reducing direct cost. So by reducing direct costs faster than your price increases is an obvious area to do that, right? So reducing your raw material costs, if you can find something at lower cost that doesn't sacrifice your quality, looking at your partnerships, finding a partner that is willing to provide it to you at a lower discount, seeing if you can get volume purchase discounts. Can you sell it before you have to pay for it? Can you reduce mistakes? And so we're going to talk a little bit about Lean Six Sigma at the end of this, but there's definitely ways to maintain lower direct costs throughout the sales process. But definitely going to your distributors, going to your suppliers, and asking for a creative way to get the products you need at a lower cost. It sounds obvious, but you'd be surprised how many companies don't do that. They don't go ask for discounts. And my own businesses, we've always gone down that path, and we've always found a few points here and there, and they add up quickly. So we would set goals with them. We'd go to the distributors and say, okay, if we hit this volume number, will you do a retroactive discount for us? Or can we negotiate better terms with you? And we'll talk about that too, so that we get paid before we have to pay our suppliers. So there was always creative ways to look at the materials coming in, whether you're a service organization or if you're create product you're manufacturing. There's always ways to creatively find cash in that process. Next area is inventory management. So obviously having too much of your cash locked up in inventory is not a good thing. It's necessary. And there, again, if you look at Lean Six Sigma, is a good example of where you can do an analysis to see when you actually need the inventory you have. That's where the just-in-time stuff has come from. But if you look at most organizations, they don't effectively analyze their inventory and look at your fast movers versus slow movers versus the dead obsolete products, and effectively manage that inventory flow in and out. So how much of your cash is held in that? And is there a way to creatively look at your distributor network, your suppliers, to find more creative ways to have the inventory you need when you need it, but not be bound by product that you're not using? Which, by the way, the C level of inventory, the very slow moving, is very expensive, because that often turns into obsolete product that doesn't get sold or gets sold at an extreme discount. So inventory turn rates and fill rates, out of stock rates, those kind of things, measuring those will give you a better perspective on what you're using. But many of my clients are in the service industry. They don't have inventory in their mind, but the reality is they do. The inventory you've got in the service industry is people. So the number of hours available, the utilization of your resources, is your inventory. So oftentimes I'll see people get caught in the trap of, they've got high paid, high value resources that they're reluctant to use on lower cost or lower value tasks. And I'm 100% for that, assuming that you can get them utilized fully. So obviously the answer is, if you can get somebody who's a 40-hour a week billable resource to be billing 40 hours a week, that's great. But if they're actually billing at 30 hours a week, you've got 10 hours of dead time. So making sure you're fully utilizing that dead time, even if it means billing them out at a low rate for a task that is even below their cost. Anything you put them on, you're potentially recouping expenses that will offset that loss. So that's money in your pocket if you can find ways to plug them in. So this example, a $200 an hour billable resource, pay them at $50 an hour. But if you can put them on a $25 an hour task on hours that weren't going to get billed at all, that's just money in your pocket. Again, ideally you want to put them on high value projects, but if it's not an option, finding ways to creatively use that time. For us in the IT services area, when we had very expensive resources, we always use that available time. We always had project lists for them that they knew if they weren't billing, they were doing something that was contributing to the long-term value and profitability of the organization. So we identified projects well in advance that they were tasked with. And so there was another way for internal billing, essentially, of those hours. But looking at your gross profit percentages, your GP per hour, unbilled time, idle time, utilization rates, those are all great scorecard measurables. So the next, accounts receivable. Obviously, having too much of your cash locked up in long-term accounts receivable. So what can you do there that will help put more money in your pocket more quickly? So obviously, you can get paid. If you can get paid more quickly, that's going to assist you because it'll help you with cash flow and paying your suppliers also and your own people. So the question is, can you get paid on time before you have to pay your suppliers? Can you get paid up front before at the time of order or before the service is delivered? I suggest reviewing your worst offenders. So some of my clients have what we call the dirty dozen. We'll look at the bottom 12 worst cases with their clients, and we'll put them on a plan. So essentially, because frankly, if you're not getting paid, you're an accidental nonprofit, right? The reality is we want to make sure you're a profitable company and that you're getting paid for the services that you're delivering. And if they're not paying you, they're not really a client. So making sure that you're looking at the worst offenders, increasing prices, but offering a discount for paying on time. That's another way to do it. I've seen, I'm reluctant to discount below for paying on time because in a way that almost rewards bad behavior. So if you can look at increasing their price, but being willing to stick to the original price, that's another way I've done it in the past. So looking at your scorecard aging, dollars over 60 days, again, the dirty dozen, identifying your worst offenders, putting a plan together and being intentional about how you manage those clients or those issues. Next is reducing liabilities. So can you negotiate better terms? I touched on this earlier. The answer is emphatically yes. It's always negotiable. Just like your clients may be coming to you asking for better rates now, you have the opportunity to go to your suppliers and ask for better rates from them. And by the way, it doesn't require bad times for that to happen. That anytime you set up a new supplier relationship, you should have that discussion. You know, what's it look like? You know, what can I do of value that would be enough value that would allow us to reduce the cost here? So if that has to do with again, quick payment, if it has to do with certain volumes that you can hit, but look at creatively how you can negotiate better terms with your suppliers. Like I said, ours was 60 days, and actually on certain products and certain vendors, we were able to negotiate through our distributors a 60 and 90 day terms, whereas our clients were on 30 and 45-day terms. And so when you've got a large project, that can really help substantially for to manage your cash flow. So loan terms and lines of credit, that's another example. Obviously, if you're not looking for better terms on your lines of credit and your loans right now, interest rates are low. It's pretty obvious. But looking at those expenses and seeing that how you can reduce those liabilities. Another area that doesn't get talked about much, especially if you're in the resale business or if you have high volume retail, is sales tax. And so sales tax is, many don't realize this, in the state of Texas, they'll actually give you a 0.5% discount on your sales tax for timely reporting. In fact, if you're a reseller and if you do tax payment estimates, that you can actually get up to a 1.25% rebate for prepaying your taxes. So if you can estimate accurately what your sales tax are going to be, and frankly, if you've got a PO process and you know what the orders are going to be, you should know well ahead of time what the sales tax should be. And if you can prepay that, you can save 1.25%, which could be substantial for many businesses. So I've put a link in here for some more details from the comptroller's office that will give you those details. But if you're not doing this, we saved substantial amount of money going down this path. So looking at your AP aging, your loan balances, interest carry charges, all those things should be considered on a regular basis when you're looking at reducing liabilities. All right, next is driver 7 is reducing fixed OpEx. So clearly defining your core processes, understanding what we do, what's the best and right way to do what we do, and make sure that everybody in the organization is clear on that. You've documented it, that everyone in the organization is following that process, that you're identifying areas where there's lost efficiency and where you can really reduce either the number of people involved in it or the time involved in executing those processes. And when you do that and have everybody following that, it's also important to make sure you've got an old term, right people, right seat. And EOS, we're really keen on building an accountability chart. Make sure that everybody in the organization has a seat. They're really clear on what their roles are, what their expectations are, what they own, and there's accountability for that seat. And part of that goes back to process, so that we know that not only what processes should be done and when they should be done, but we know who's accountable for those processes. So that will, in turn, reduce OpEx. You'll find inefficiencies that will get cleaned up in that process. Looking at expense creep, it's very common in any organization. It's common in our personal lives. How many subscriptions do you have on your credit cards for different channels or recurring costs that you don't either watch anymore or need anymore, or the subscription that you're paying for that you just forgot that you had? So that's really common on a much larger scale within businesses, of finding expenses that you no longer need and that you can eliminate or reduce the cost. Again, this is an opportunity to shop or renegotiate it. And then the issue of bottom-up spending is something I'm seeing, especially for my medium-sized and large clients, where you're starting to see spending further down in the organization, either buying licenses. Let's take Zoom, for instance. If you were a 200 employee company and you had a lot of office workers and you had multiple people subscribing to Zoom, is there an opportunity where you can roll that together and get an enterprise license, and so that everybody's working off the same license and you can reduce the overhead count? And so there's so many cases like that where you can significantly reduce your expenses by analyzing your bottom-up spend. So putting in place clear policies on who can buy what, on what you're willing to expense, and use technology to do that. So there's technology today that will actually scan through all of your accounting system and look at your expenses, and it'll see where you've got overlap. Hey, you've got 3 licenses of this Adobe product but only one person's using it, or you've got something that's been lingering there. Just like the old subscriptions in your personal life we're talking about, businesses have that, and there's technology to help you audit the subscriptions and consolidate or identify where you can eliminate. All right, lastly is reducing waste, mistakes, and rework. And this is really where we could spend days talking about this. And again, I keep talking about Lean Six Sigma. It's just a combination. If you're familiar with Lean and Six Sigma separately, it's really about making sure that you're reducing waste and that you're providing the most efficiently providing the best quality products out there, so that you don't have rework. You've got client satisfaction. You're not having to go back and redo work, which equates to waste. And so making sure you don't have process waste, understanding your cycle time, your scrap rate, that is a huge issue. Every organization has waste, but understanding how to quantify that waste is where you're going to find a lot of money. And I know that clients of mine have found it in every aspect of their business. And it's just one where you spend a little bit of time looking at what you do. You start reporting it on your scorecards and asking your leadership team to bring it to your weekly meetings, everything that they found, they saw, that got redone, and start quantifying that and see if you can identify the processes that are broken that are creating those issues. So it's not difficult to discover. Sometimes it's just takes a little discipline to buckle down, spend the time to analyze it, but it definitely is worthwhile. So I've given some ideas here on the process you'd follow, defining the problem, make sure you're measuring the extent and cost of the issue and analyzing the root cause. That's really where you see the real solution coming from. Improve, test, validate, retest, right? So it's a continual cycle. So I've touched on a lot of the areas. We want to leave time for QA. I know these are really simple concepts, and I'm hopeful that as we've gone through this, there's something that was probably there that was nagging, that there was an issue that needs to get addressed that you've been thinking about over time. But if you will spend time in each of these areas, these 8 areas, with your team digging in, you will find money that's either being wasted or opportunities where you can improve your profitability in certain areas. I promise you will see an improvement in cash flow by just spending a little bit of time focused on each of these areas. So again, it's real. It's very simple. Doesn't mean it's easy. You will get results by going through this with your leadership team. And I definitely find some are amazing at the discipline and the impact of going through this exercise, whereas others, not so much. It just depends on how deep and how much effort you're willing to put into that. So want to leave some time for QA. Andrew, I know that you've got a few questions that have been teed up ahead of time.
Yes, I do. Thanks, Jason. Thanks for going through all of that. Here are a few questions that were submitted. One of our guests would like to look into utilizing a line of credit. Do you have any takeaways about, when's the best time, why, and how you should use it, and some of the other best practices?
It's a deep topic. You could talk about drawing down on a line of credit in times like this, or tapping into it. The reality is the line of credit can be used for a lot of different things. I would say, from my perspective, it would depend on why are you tapping into it. If you're tapping into it because of cash flow, I would first and foremost make sure that you're maximizing your cash flow. So all the things we just talked about, if you know that you're completely efficient in each of these areas, then a line of credit may get you through as a bridge, depending on the situation. So I'd first make sure you're efficient there before tapping into it. But if you have to tap into it, I would say it's going to depend on the situation that you're in. But Gary or Al or any of the guys, do you have any thoughts on the best time for it?
Let me add a layer to that before they chime in. Someone was asking about, I think, a particular group, Main Street Capital, but maybe let's round that out. And since we're talking about whether you should take a line of credit, debt, maybe we talk about equity partners if you have cash flow needs. Is there, a pro or con to both that you would choose to take one over the other? Debt, equity, that sort of thing.
Yeah. This is Gary. I think the point of a line of credit is to be used for current activity, not for long assets. And so a line of credit is something that you should be able to pay back in an accounting cycle, which is a 12-month period. And so, the decision should be reached. I mean, of course, if there's not a choice and you've got to survive your company, you've got to tap into all your resources to be able to sustain. But ideally, what you want that line of credit to be is for peaks and valleys, to where you can sustain current period cash flow and then repay it later on in the accounting cycle.
Yeah, that's a good point. And equity could certainly be used more on the growth capital expenditure side. Debt could also, but I would say if you're raising equity, it's not a cash flow need.
There was a question on Main Street Capital as well. And Al, I don't know if you have anything you want to contribute to that question that came up.
Oh, he might be muted. We'll have to unmute him.
We can circle back to that too, if he's not on mute.
Well, we'll hop over to the next one. The next question was EBITDA versus, or free cash flow versus net income. Why, which one's the more important benchmark for a business? Which one's used more in valuation? What should you focus more on as a business owner?
So I'd say It depends on what your intentions are. Obviously, cash flow is going to be really key to making sure that you're a healthy company. But it depends on the perspective of the question, I guess. And Gary, I'll let you chime in from a valuation standpoint in a healthy organization. You want to touch on net income and EBITDA and how that would relate to it?
You know, a lot of times it depends on the purpose of the valuation. What you use, if you use free cash flow or EBITDA, you know, net income after taxes. So there's various purposes, and Al may be able to chime in on that a little bit better than myself. But from a standpoint of business operations, you know, and looking at sustainability, I mean, I think free cash flow would be my first choice because that is a stronger matrix for, you know, what you have available, how much money you'd have to spend, you know, to continue your business and to possibly recapitalize it or purchase long assets. You know, a lot of times in M&A, people, we use EBITDA, you know, it's basically the benefit stream and then do normalization adjustments to it in a transaction.
Yeah, and I think I mean, kind of the textbook MBA answer to that too is, you know, when you're looking at EBITDA versus net income, you're taking into account all the, you know, the tax implications, debt, and things that could theoretically be restructured with a different organization. And so really they want to just see how much actual free cash can this business generate, because there's other things that can be manipulated to change profit. And so really it's, you know, what's the raw cash generating ability of this business?
That's right.
Yeah, at the end of the day, it's all about cash flow, and all accounting is up to interpretation.
That's right.
So it's all, the bottom line is always what the cash flow is, free cash flow.
Yep.
For all expenses, capital expenditures, and everything. So valuation becomes real simple when you can understand what your cash flow is.
Right.
Yep.
Got a few other questions here regarding, one of them regarding product. What is the goal that should be set for productivity? Should it be above 1.5?
I would say it totally depends on your business. The industry itself is going to depend on it. You know, the reality is, even within a business, we see variations of what's expected. So there's certainly best practices. For instance, I do a lot with managed service IT organization. We set specific productivity. The 167 is what we target for that industry, but it is going to vary on your specific company. Gary, do you guys, or you or Al, have any thoughts on that though?
Well, we had a follow-up question to productivity, so maybe this will open it up a little more. How would you track that, and at what frequency? Would you use a scorecard? Would you do that monthly, weekly, quarterly?
So we do it on a scorecard in EOS. Well, many of my clients will track it on a scorecard. The reality is it gets difficult to do on a weekly basis because there's a lot of variables that are hard to account for. But looking at it monthly is a little more practical. And so knowing that it's not going to be perfect, but you can account for some variations there. But doing it on a monthly basis is I think realistic and important to understand, because ultimately we're looking at margins, we're looking at gross profit, we're looking at all the things we listed. Those 8 areas are going to come into play. And so part of that productivity number is really just a measure of how effectively you're doing all those things. And if you're continuing to sustain the pace that you're setting for yourself, the expectation. But setting a goal, I think, is really key. Understanding where you're at, setting a goal, and managing against that is going to be important. And then if you're not hitting that goal, understanding specifically why is going to be just as important, obviously.
And, you know, I'll chime in a little bit. With our EOS, we're able to do a pretty effective scorecard on a weekly basis as well, with the type of business we're in, being in an accounting world. So we're able to look at productivity, realization, collections, billings, things of that nature that really keeps us focused in on what our cash flow looks like. Sometimes I think business size, complexity comes into play. And like Jason was saying, it's easier to, an accounting period could be a month and you could have strong cutoff to where you can really measure on the accrual basis of accounting and on the cash basis.
But the key is measuring it. Find something that works for you. Make sure that you're able to accurately and effectively report on it. If it takes you 2 weeks to produce that report, well, that's a problem, right? So we've got system issues we need to address, but getting it to where you can effectively report on that. And we talk a lot about the scorecard, and it really is, if you're familiar with KPIs or any of those measurables, really just talking about measuring what you do and tracking it on a regular basis. So in EOS, we have a 13-week moving window that we track. We set not just the measurable, but we set specific baselines and goals per measurable. So when a number moves, we understand what the history of that number was, and we can understand why it moved. So.
Yeah, I think a good thing is finding the right cadence for your own business. But whether you like it or not, even if it is your own business, if you do it too drawn out, then you're not going to get an accurate picture, I feel like. And if you do it, something like weekly or daily, you could get fatigued by that and burn out. I know when I worked at one of the large bulge bracket banks, we had a daily task tracker in one of my first roles, and it just became monotonous, and you end up not paying attention to it because
well, you want the numbers to be real. You definitely don't want the numbers to be fudged just because if it's too frequent, that will happen. Right. People will report bogus numbers, but we want the real numbers on a weekly basis. What the benefit of that in general with a scorecard is that you can make micro corrections along the way versus a big correction. So the problem with quarterly, for instance, is it's all rear view mirror management. Yeah. By the time you get to the end of the quarter, it's too late to affect change. And so what we're trying to do is have a ongoing regular perspective on the health and progress of our company, so we can make micro changes to affect the ultimate goals.
And then I get just peeling this back one more layer for accountability, not just productivity, but accountability. That's all tied into the scorecard as well.
So every number is owned by somebody. So just like what I talked about today, if you've identified an area of potential improvement, put a number on it. Figure out if we can shift this by a half a point or 2 points or whatever you think is reasonable, write it down and put a name on it. Who is responsible for that? So if it has to do with the sales, maybe your VP of sales is the one that's going to own that. But in EOS, everything has an owner. And so the idea of accountability is that the person that is ultimately responsible for this is the one we're going to go to and look to understand what the number is, for instance, and be able to explain to us why it is what it is. And so on the scorecard, you will have an owner of that number, and they'll be responsible for the reporting of it as well as the addressing of any issues that come from that.
Great. Well, that's all the questions I've got, unless anyone wants to shoot them in the chat. I'll pass it back over to you for closing remarks. But if you guys do have questions, afterwards, obviously you can reach out to us and to Exit Advisors team or to Jason.
Right. Yeah, definitely. So I appreciate that, Andrew. So we do have this is a weekly call. We got another one coming up. I think Al is doing the one next week, which is the unexpected business exit. And so we're looking forward to that. We'd love to hear from you guys. If you have questions, you have thoughts along the way, let us know. Again, if there's anything we can do to help in the meantime, I'm more than happy to answer any questions based on our discussions today. I know Gary certainly, or the rest of the Exit Advisors team is more than happy to help out. We will send out, there's my contact information. We'll send out the slide deck to folks so you have our contact information and any details you have and any subsequent questions. If we can help out, let us know. These workshops usually take about a half a day. If you're interested in doing something like this for your business, it's usually very, very productive and pays for itself pretty quickly. Like I said, the one on Friday was a $40,000 an hour day. So not bad. So, but let me know if we can help, and I appreciate you guys joining and your time. We look forward to seeing you next week.
Thanks, Jason.
Thank you.
Thank you, Jason.